Happy Friday, folks. Well, the good news is right through here that we're seeing the mortgage MBS market doing okay. It's up 16 points, but I don't know about you, but I'd rather have a higher interest rate and not be losing my butt in the stock market. I don't know about you guys, but I'm a homeowner. So just wanting to go through where we are for the day. The MBS market is doing very well. Look, it's rallying through the end of the day, which I like. The biggest thing here is there's really no news. Let's see down in the headlines what we see down through here. This is all the data that I get and I provide you through the newsletter that I post every day. So if you want to get involved with the newsletter, it's free. It's down below. Sign up for that. We're having about 50 people a day. So sign up while it's still free. So we'll go down through here. The Black Knight's first look at April mortgage data. That news came in actually pretty good. Jeb Smith, he's a realtor out in California. He does nice reviews on a lot of this stuff, as well as Nick with Revolution. Shoot, I forget Nick's website. But there's a lot of data out there. There's also the Uneducated Economist. Check out that guy. He is amazing. He nails all this stuff. So what I do is I follow a lot of people on YouTube that are not in the mortgage business. So I'm trying to get them a part of the show. To give their unbiased opinion in a lot of this, where it's CEOs of companies. I'm friends with some of those. I'm reaching out to those guys. I reach out to the Uneducated Economist, and he actually was kind enough to get back with me. If you're not familiar with his channel, please check his channel out as well. But they give you the unbiased opinions on a lot of this stuff, and that's why I like having them a part of the show. So a lot of times you guys think, I'm in the mortgage business. Yes, this is what I do for a living. So yeah, I might have some bias toward home ownership because it's my living, but I own a house and I enjoy owning the house, and I've created value in home ownership. So the economic news, there was none today, but let's go down through here. You can't see this real good, or I'm not sure how good your screen is, but let's just go down through here. We're in a bear market. That just hit, those triggers hit today. If you saw my recession video last night, I tried to make it as quick and as efficient as I could, just to say, okay, what is a recession? Because most of you just think, okay, we're going into a recession, the world's going to end, basically back where we were in 2008 and 10. No, it's not necessarily that. It's basically the definition is two quarters of negative GDP. So we've already had the first quarter of 2022 negative GDP, and we're pretty much expecting the second quarter to be negative GDP. So as the definition reads, we should be there. Okay. So the only thing I see that's really affecting this market right here is the people just getting out of the stock market. And you can see the Dow Jones right now is down over, just was down over 500 points, but now we're only down 480. Let's go through some economic indicators. I just want to pull the screen back. So if you're on here, if you got any questions, please ask them. I do the midday report just to give you guys up to speed on what's going on with mortgage rates. Let's go over to see where mortgage rates are published through Mortgage News Daily right now. See if they updated their information. Yeah, down 0.08. Yeah, I think that's pretty much updated from where we were. No, I don't think it has been, because this morning I think we're at 5. So they have not updated. But let me go over the economic indicators. And this is a website that I use. I don't know if you could see it up through here, but it's called tradingeconomics.com. And you can go into there's all kind of tabs up here. This is an amazing website. I highly suggest you go to it and at least use some of the tools if you're interested in this stuff. And if you're watching this, you probably are. So if you're watching this, please give us a thumbs up. Let me know you're here. Let me know where you're coming from. I'm going to make this short and sweet. If you got questions, please ask. But what I want to go through is some of the indicators on the recession and things that are coming up. Now, I think a lot of stuff out there is going to make or create, I don't want to say this. What's that thing? If you pump out that data so much, it just makes it come true. So yeah, we way overstimulated the economy. We all overstimulated the economy. It's part of a group effort. So we can't really say, hey, the Federal Reserve did absolutely this very much bad. There was a whole bunch of context in there, but you could check out a lot of the data. We're going to come out next week with a slew of information for you. And I think you're going to start liking the channel even more and more and more, as well as a lot of the aesthetics that we have. So that being said, let's go to the GDP right here. It's pretty simple. We did last quarter was negative. The previous quarter, we were up 6.9, and then we went to a negative 1.4. Think about it. That's over an 8% swing. okay, in the wrong direction. The growth rate here, I won't go through all these numbers. You can see, went from 5.5 to 3.4, 2.1433 to 2.09. So you can see, you get my point there. Okay, let's go to labor. The unemployment rate was 3.6, remained at 3.6. All these numbers are the same. Government payroll, they actually went on a hiring craziness, and they added a bunch of employees at the government level. You can see the non-farm payrolls are down, manufacturing payrolls are up. This is where we need the ones to be. Initial jobless claims up, unfortunately. Continued jobless claims, which is down just a little bit, and ADP employment changes. Okay, so that's that. Prices of things, here's where it kind of gets really off the charts. Inflation was 8.5, now we're 8.3. Okay, whatever. We all know that everything's going up crazy, especially energy prices. But you can see all through here. I won't go through all the data. I'll try to post this website down in the description down below. But when you go over to housing, and let's go to consumers, consumer confidence is plummeting. It's off the charts. Retail sales down. Retail sales ex autos way down. Retail sales year over year up, but I think we've peaked. Consumer spending, we're still spending like, don't think this is just a joke. Funny, a drunken sailor. I don't know where I got that. That's an old thing that I used to hear. Personal spending, we're still spending way too much. And consumer credit, you can see how, look right through here. Credit is skyrocketing. Again, prices are going up. People aren't making any more money. Okay. But consumer credit is starting to spike. And that's my fear. A lot of people are still spending like they spent last year and the year before, when they had, again, I'll beat this dead horse till it's deceased and decayed. You didn't have, when you had forbearances, you didn't have to make a mortgage payment. Student loans are still deferred. Most of the applications that we have, most people have either a mortgage, a student loan, and a car payment. Okay, everybody has those things. So if you didn't have to make a mortgage payment and a student loan payment, you probably were flush with cash the last couple of years. And I showed that with consumer discretionary income. I showed that chart before just to prove to everybody that the consumer. Hold on, let me see if I can find the chart that'll give us that disposable income. I'm getting somewhere here. This is one of those things that's really crazy. I don't know if this is the chart I'm looking for. Look at it right here. Okay, so those that think I'm nuts, look at the disposable income on that chart. Look at when it took place. Okay, March of 2021. That was the biggest spike, the most disposable income that the Americans consumers, real disposable personal income, ever. Okay. How'd that happen? When we had a shutdown, nobody was working, and so forth. So that's what, just another proof that a lot of the stimulus money went toward savings, okay, or disposable income, and people were spending it. So now we have a supply chain issue that once the supply chain gets caught up, well, we have now China and everybody else backlogged again and shutting down with the monkeypox or whatever else is out there. We're going to have another round of this. And I learned that from the uneducated economist. The guy's fantastic. I can't say any more about him. He's in retail sales. He works at a lumber yard, and he's giving quotes on what's going on with lumber prices and all this stuff. He has a read on the pulse. I asked him to join us next week just to give us his feed, because he has no dog in the hunt. He's not going to talk about mortgages and housing. He's just going to talk about the general economy. And I'd love to have him live so you guys can ask him questions as well. But again, you can see right here, we had the most disposable income basically ever in history. What do you think we're going to do with that? Well, most people are going to save some, and then you're going to spend the rest. And we just spent. It was convenient. I did as well. Amazon, to buy something now, you go here, click, find a TV you like, click, and it's delivered to your house tomorrow. It gets really simple. But you're starting to see, job cracks, employment numbers going, or the money, payroll or wages going down, and a lot of other things. So good news for the day is mortgage rates are starting to stabilize and get a little bit better. Bad news of the day, our wealth is just being completely deteriorated because of the Dow and all the other stock markets. I don't know a safe haven or where to put cash right now. That's the toughest thing, even in my personal life. If you sell out of the stocks, which I didn't, which I knew all this was coming, and I just sat and watched everything deplete. But where do you put it? If you put it in here, it's a bad idea. If you put it in, bonds, probably not the best time to invest in bonds right now. Do you go short, meaning you're going against the market? So when people invest, it's called, you can invest long or you can invest short. When you invest long, that's your normal. You buy a stock, you hope it goes up in value, and then you sell. When you do it as a short, you actually sell the shares by getting it borrowed from somebody, and then you have to replace those. So you're betting that the price goes down. That even scares me because, what was it? I think yesterday we had a 400 plus rally. I think it was yesterday or the day before. I'm getting so confused because every day just goes, up 400, 500, down 400, 500. It should be moving in increments of like 20, 50, 30, 80, 100, maybe, not hundreds. And that's the biggest fear that I have right now. So that's where we are for the day. The MBS market continues to move. It's basically stabilizing. It's probably going to close, or will be closing in about 2 hours. So there's not much new coming in today that I know of because the economic calendars are basically blank. So if you have any questions, please post them now. Otherwise, that is it for me for today. I'm going to clean up and finish up everything I have to do. Reach out to a few more clients. If you're out there looking this weekend and you need pre-approved or you need an update, or you're out there and you're like, hey, I got a pre-approval or a quote from a lender, we'd love to review that with you. What we do is we're one of the largest brokerages in the country. We can scan your quote to over 130 lenders in the entire country. That's what we do. So send us your loan estimates. Let me give you my email address right here. I think this is it. Mine's the Dan one down below. If you have a loan estimate from a lender, if you're not locked, that means who knows what your rate's going to be. Just because last week it was 5.25 doesn't mean you're going to get 5.25 today. So you can see the volatility in all this. So let's look at just what happened this week. Look at that. Okay, look at it. All those oranges are when banks repost their rates for the good or the bad. When it's going up, they're doing it for the good. When it's going down, they're doing it for the bad. So again, this is the mortgage-backed securities chart. As this goes down, the price goes down, rates are going up. Okay. As this goes up, rates are coming down. And you can see this is basically where we are right now. So we're starting to have people reposting for today. Unfortunately, only 3. You could look down here. 3 lenders got better rates today. So this is how we keep track of the markets and also lenders specifically to see who's being more aggressive at this time and not. So that is it right now. Next week, I'm trying to get an action-packed, eventful week for you guys, bringing on guests, especially outside the market in manufacturing and a bunch of other things, to just give you a bead on what the economy is doing, because I look at the broad scope of everything. Housing is a piece, but housing is hugely affected by all this. So that's why I'm trying to reach out to a lot of people to get more and more context for you guys to make sure you're an educated consumer. You're educated. Let me say my tagline. I'm going to leave it at this. My goal here is to educate and inform you guys everything real estate, especially when it comes to the financing options. So thank you so much for watching. If you got any quote or questions, please post them now. Otherwise, I am going to clean up, finish for my day. And hold on, I got a question. Dan, what do you believe rates will be? That's my number one question. I'm saying at this point, is this a false bottom down through here? I don't know, but I can see rates going to the 6 range. Just talked with somebody today that's expecting summer gas prices to be at least 6 or higher. So here's my take on a lot of this. I think the Federal Reserve isn't moving as proactive as a lot of people are pumping them to do. And the reason being is just fuel prices alone, just fuel is skyrocketing prices everywhere. So that alone, think of fuel, is you go to the grocery store, basically everything got there by truck, okay? Because trains don't go into that store. Diesel, look at the price of diesel on your way home tonight, or if you go out tonight, look at the price of diesel. It's way above gas prices. So if you think you're feeling the pain, how do you think all the people that are getting our products from the ports to the stores by truck, refrigerated trucks. Also, the cooling systems run on diesel. Okay. So if you're a proponent of EV cars, I do a lot of research in all this stuff. I live a pretty boring life, I'll say. So I really have been diving into electric vehicles and even TED Talks. There's some TED Talks I've been watching, and the best cars out there right now are hybrids. The EV cars, the only way EV cars really make sense, and it's a TED Talk. And I take that with credibility, because these are scientists, engineers, and yeah, maybe they're skewed a little bit on their views, but the EV cars, aren't our future, because the lithium batteries and so forth, they take a lot, they create a huge thumbprint in, you guys know what I'm talking about, on the carbon footprint, the huge carbon footprint. And did you know most of the lithium comes from China? So that's not a good place to be reliant on your supplies with. So the next wing. But to answer your question, Blue Migo, I expect rates to be, between here and 6%, maxed out at 6%. The federal. So let me go back. I'm sorry, things are popping in my head. You might be hearing a lot of times right now that everybody's saying the Federal Reserve is behind the curve. So what their expectations is the Federal Reserve, the federal funds rate, the Federal Reserve controls, should be at least at the inflation rate. Okay. And everybody's like, they should, pop up rates fast. Jim Cramer just came out, and I really don't like the guy. I used to follow him a lot, and he's just a cheerleader for stocks and all this other stuff. Shoot, I forget where I was going with this. I forget. So I know I ramble, so my apologies. Let's go to the next question. What, after you purchase a home, for example, so when can you refinance that loan? You can refinance the next day if you want. So that's why I keep telling people, watch the markets. So I see things starting to stagnate. You can see it right here. We might be at a bottom, but I'm getting back to the Federal Reserve thing. So do I think the Federal Reserve will raise the federal funds rate to 8? There's no way in the world that's going to happen. Here's what I expect. By the end of the year, the inflation will be down to 5 or maybe a little lower. So then people are still saying, well, the federal funds rate should be 5% or more. I still disagree, because the pain that we are all feeling from the pump alone, okay? The pump is escalating prices on everything. Think about it. Food costs up. Everything you buy is basically trucked to you. So that alone is really going to drive up prices on everything and have people starting to tighten their belt. Also, the wealth factor, or the wealth, everybody's, I can even say 2, 3, 4 months ago, felt much wealthier. Or I'll say it this way, were way wealthier than they are today. I don't know the exact amount of money that has been lost in the market during this crash, but this is just year to date. We were up at, sorry, I got to put my old man glasses on. This is all data you guys can get. I try to just give my spin on it. I have a degree in economics, and I've been in the mortgage business 30 years, and I love this stuff. So we go back here at the beginning of the year, the Dow was at 30, let's say 36,800. Okay. 36,800. So we're down 6,000 points. I didn't even realize that. My goodness. Are you kidding me? Sorry, I'm doing this live. Close. 36,000. I'll just leave it at that. We're at 30,000. Yeah, we're down 6,000 points. So 20%. That's the bear market trigger. So we are in a bear market. Like I said last night, I said, just watch. We could be there any day. The end of June will be the next cycle of GDP. If that second quarter GDP comes in negative, that means we are in a recession. Or at a recession. So I'm not going to say, 5, 6, 7 months from now, look back and say, oh, we were in a recession at the beginning of the year. So now what does a recession mean for you? How do you protect yourself with that? Unfortunately, in the markets, we lost our values already. But I don't like to pump the fear piece of things. You wake up every day and I flick on the news, and in Chicago, 8 people were murdered. And then you have all the race stuff and all the other stuff. And I just want some good news. So I'm trying to just, take this and give you a silver lining behind a lot of this stuff. It's tough. But the recession doesn't mean the world's going to end. Okay. We need to tighten up our belts, and we all need to. Let's look at it. Let's just say we overindulge for 2 years. Now it's like a diet. if you gained a bunch of weight over the 2 years, you can't just say, oh, I'm going to stop eating for a week and you go back to right where you used to look like. It doesn't happen that way. You're going to have to start working out, cutting back on food and everything. It could take 6 months, 8 months, a year till you get back to where you were. Okay. That's the same with the economy. So we go into a recession. It's not a depression. I don't see housing market crashing. Okay. Unless rates get to 8 or 10%, then all bets are off. Housing will probably crash. Okay. But if we stay in the 6% up to a 6% range, okay, it's manageable. All right. So that's that part of the equation. There's still huge demand and it is depleting. I can vouch here. We usually get 15 to 20 applications a day. Now we get maybe 5. So it's down, we're doing 25%, 35% of the volume we normally do. That's okay because we run lean and mean here. But I'm just letting you guys know the call volume has even depleted a ton. What does that mean? Well, that means less people getting pre-approved. Okay, that's bad for me. That's fantastic for you guys. Why? You have less less bidders on that property. And this is why I talk to realtors every day. Over the last couple months, we went from having, 20, 25 offers on a house that would overbid on average, $10, $15, $20,000 up to $100,000 to now you're getting back to the norm of 3, 4 bids on a house. That's what we want. That's a normal, solid, steady market because you don't have all these bidders, just FOMOing. I got to get that house. I got to get that house. I was on a show the other day and a realtor was talking that their buyer, and they were happy about it. I mean, if the buyer's happy, I'm happy for them, but they overbid on the house by $100,000. And the house was only $200,000. So they bid $300 on a $200,000 house. Not smart. Okay. But if they stay there the rest of their lives forever and they love it, God bless them. It's their money. It's their house. They do whatever they want to. But again, I'm not pumping FOMO. All right. So let's see what other questions I have. But Alfredo, you can refinance anytime. As soon as you close, basically as soon as the deed gets filed, you can refinance to a lower rate at any time. For the first 6 months, you have to use the purchase price. And then after that, you can use the new appraised value. So if you're out there, I'll just give a pointer to some people that are out there and have bought in the last year or two, and you have PMI. So there's 2 pieces of this puzzle. If you have PMI on your loan and if it's not an FHA loan, okay, I would highly suggest you call your lender and ask for a review to see if you can have your PMI removed. All right. What they're going to do is either a desktop evaluation or get an appraisal done for you. And just let's look at the logic behind this. You bought your house a year and a half ago. Well, in 2021, the average home value went up 18%. Okay, well, what does that mean? Well, you only put down 3% or 5% when you purchased the house. Okay, so now your house value went up 15, 20%. Right now you can refinance and you'll be under an 80% what we call loan to value. So you should be able to remove your PMI. That PMI the removal of the PMI could save you, $200-300 a month. I mean, that's a fantastic situation to be in. So if you're out there, you have your mortgage and you've had it for a year, call your mortgage lender and have them check to see if they can remove the PMI. If you have a VA or an FHA loan, you can't. You'd have to refinance it into a conventional loan. And most likely it doesn't make any sense to do that right now unless your rate's 5 or higher. But if you have a FHA loan, your rate's 5 or higher, I'd highly suggest call in and maybe look into doing that. Because even if we refinance you at a 5% rate, you remove the PMI, and that's going to save you, hundreds of dollars. And I meant to say that last night on my video, but I forgot to do that. So, but ask any questions, you guys. It's a Friday. Once I'm done answering questions, I'm going to finish my emails and get out of here. So let's see the next question. If the Fed raises rates 5 to 6 times this year, what will that do to mortgage rates? So let me explain again what the Federal Reserve does. They control what's called they don't even really control it. They kind of in a roundabout way. They control the federal funds rate. Basically, what that means is it's interbank lending. So let's say there's 2 huge banks, Citibank and Wells Fargo. At the end of each day, they have to have X amount in reserves. So let's say they have to have 10 billion in reserves. All right. Well, let's say one day Citibank has 8 and Wells Fargo has 12. Well, Citibank reaches out to Wells Fargo and says, hey, I need $2 billion to meet my reserve requirements. They're like, okay, we'll send it over to you kind of fictitiously in the books. But you're going to be, and they lend them that money overnight just to meet that requirement. And it's the rate that they charge each other back and forth. But what it's really used as is a measuring stick for all consumer credit, meaning credit cards, not long-term debt. Long-term debt, such as mortgages, is actually tied to the mortgage-backed securities market that we follow right here. Okay, so what happens with mortgages, why it's different, is I don't know what you guys like better as a backdrop, this or this. Let's keep it on this. This is kind of cool. I don't know what you guys. God dang it! I lost my train of thought again. I had a rough night. I got allergies and my eyes are itching like crazy. But so that's what the federal funds rate does. But again, what the federal funds rate does is it's a measuring stick for consumer debt and everything else. But mortgage loans are tied completely to the mortgage-backed securities market right there. Okay, right there. So it's in competition with the treasuries. So let me make it make sense for you. If you had $100 to invest, where would you invest it to? Well, let's throw away crypto and all the other crap right now. Let's say you're going to buy stocks or bonds. All right. So usually the correlation between this is flip-flopped, meaning, and this is a great representative of it today. Stock market's down 400. So what does that mean? People are selling stocks or they're losing their butts. Well, if you sell, you're like, okay, I don't really want to be sitting in cash at the bank making 0.000001 when inflation's 8. So you're losing your purchasing power of that dollar. So you try to find something to put it in to give you some yield. Okay, well, you can put it in bonds. Mortgage-backed securities are a bond. They compete with the 10-year treasuries and all the corporate bonds and everything else. So that's why, that's the context of all this. So, but when the federal funds rate does go up, your credit card rates are going up, car loans go up, personal loans go up, all that stuff will go up basically in tandem because the banks use that as a gauge. But mortgage rates kind of follow it a little bit, but it's not completely tied to that. So again, the Fed will probably raise rates about 5 to 6 times this year. Let's say they go 50 basis points each time. So that'll put us at 3 plus where we're at now, 4.5. That's where I think we should sit because I can see inflation by the end of the year being 5. So if they bring us up to 4.5, we'll be where we should be. But I'm not a proponent of them going in, pumping up the federal funds rate by 1 full percent for the next 5 or 6 times and getting the federal funds rate up to 8. The economy can't handle it. We just can't handle it. That with energy prices and everything else, it'll completely shock the system. They can do it. If they do it, we wish we would have sold out our stocks right here. I'll tell you that part of it. But okay, so let's go to the next question. Mortgage application will continue to drop as interest rates rise. Will that give it time for inventory to accumulate? Yes. So you're going to have a combination of great question, Blue Migo. We're having a combination of 2 different things, and these are both positives for the consumer. Okay, we have more and more supply coming to market. Okay, we even have more and more. Let's just look at the supply chain. Okay, there's tons of products sitting out at sea right now. Okay, but then you have China. They can't really produce much more right now because all the ships are sitting at sea. So they're sitting there. And then you have all this other monkey virus stuff and everything else that's, I don't know if half this stuff is real, playing havoc on it. So once these ships dump everything, we're going to have way too much stuff. And then they send the ships back. Or are they going to load it up again and ship a ton of stuff back? No, because our stores, such as Walmart, Target, all these companies have too much stuff that people. I just had a dishwasher installed. We ordered it 9 months ago. Okay, so I almost just said, screw it. I don't even want it anymore. But you see where I'm getting with this. It's going to be the uneducated economist calls it a whipsaw, and I'm getting it now. And that's why I follow him because he talks about lumber and construction prices and everything else. But so what we're going to see is more and more and more homes coming on the market, less bidders. But what happened back in 2008, 9, and 10, look at it this way. The banks basically just shut down. They're like, we are not lending to anybody. Okay. So what happened is that you couldn't get a mortgage. All right. And then people were underwater on their homes because house values just went like this. Nobody had any equity because everybody was buying up to that point at 100%, no income, teaser rates, adjustable rates, all this other junk. And then that's when the world basically just went kapoof. Okay. This is a different story. This is the world shut down and it's a supply chain issue. So think of it this way. Once all the builders get all their supplies, all these houses are going to be finished fairly short term as long as there's labor. All these houses are going to go woof, and everybody's going to get into the houses. So it's going to bring down or bring back into equilibrium the supply demand. The demand is cooling off and the supply is ramping up. I'm perfectly fine with the demand cooling off because it was overabundance. So now we need to get back to that normal level. So what a lot of people are saying is there's going to be a huge glut of houses coming on the market. Well, why? Okay, let me go through that. I highly monitor the foreclosure rates. Now you're going to see a lot of headlines saying, "Hey, foreclosures are up 130%," and this and that and this and that. No, foreclosures right now, if you look at the studies and you look at the facts, they're at an all-time low. Mortgage delinquencies. Okay. And I'm talking to people. I talk to clients every day. And a lot of clients are, they call in to kick the tires or they're looking to buy a second home or something like that. And they're saying, well, I have a mortgage on my house and I was in the forbearance and they modified my loan and I got a 2.8 rate on a 40-year term. Well, they're probably never going to sell that house unless they have to. Okay, so you don't have foreclosures hitting the market because the banks learned their lesson there. You don't have a lot of consumers really putting their houses up for sale because where are you going to go? All right, so the only inventory you're going to really see in abundance is what's being built. So when all the supply gets here, you're going to see a lot of new construction finalizing, but there's still going to be a limited supply. Even if demand, yes, I know, I can prove it. I can tell you now, demand is shrinking, like crazy shrinking. Okay. But there's still demand out there. There's still a supply demand equilibrium is the best I can say. Dude, you joined me today. You always comment, but you never come on. These mortgages are about to freeze. Dan's about to get skinny just in time for bikini season. Thanks, man. Were you on last night? Yeah, I did show my pool. I wasn't doing that to brag. I just spun my thing around because I did the live event last night in my backyard. But dude, you were the first one when this guy started, I don't know if it's a guy or girl, when they start posting, they posted on every comment of my videos. And I thought they were just being mean. And he's like, dude, I'm just posting to help you out. So I greatly appreciate that. I thought you were just being a jerk at first, but I take a lot of things to heart. So I apologize about that. But you post all the time. And many times when you post something, it's well needed on my end. You give me a chuckle. So what's that? Don't say anything really bad. Elbow cough, good vibes. Thanks, man. I appreciate how you help me. So I'm trying, if you're out there and somebody who would like to collaborate on a video, maybe they work in a lumber yard, they work in construction, they're a construction owner or whatever. I would love to talk with them, put them on this format so you guys can ask questions directly to those people that are unbiased to, real estate and housing. Yes, this is my living. It's all I got out of college. I went to West Virginia University, got out of college, bought a car for $3,000 with all the money I had in the world. And I moved to Chicago to try to get into the stock market. Nobody would hire me. Some company hired me as a mortgage broker back in those days. And I've done it since 1989. And it's all I've ever done. I never got out in the good, the bad, the ugly. I just stick it out because I really do love this business. So I don't try to pump FOMO. I'm just here to educate and inform you guys. Almost all our business comes from this platform. So the last thing I want to do is, point you guys in a wrong direction. Then you can come back and say, well, he was full of crap or whatever. I try to give you all the context in detail. So Antonio, let's see what you got, buddy. The Fed hasn't even begun. Yeah, you're right. Unloading the balance sheet yet, not telling how holiday 22 will look. No correction or crash this year. 2023, 24, high possibility of moderate correction. I agree with you. I'll go with that one. That's what I lose sight on a lot of times. I love when you guys post this stuff. Yeah. So let me explain what Antonio's saying. So the Federal Reserve they were buying. So when we go back to this chart is basically determined by, like any other price is determined, supply demand. Okay. Yes. So supply demand, and wherever the equilibrium hits you, that's where the price falls. Okay. So what happened during this duration, let's just go way out to here, back through here, Federal Reserve was buying 40 billion, 40 with a B, billion in mortgage-backed securities a month. Okay, so there's finite demand. So you're looking at a widget. We got a widget. It's this price. All right, there's this many. But you got the Federal Reserve stepped in. They're saying, we'll buy 40 billion of that a month. Well, what happens? Well, the price continues to go up, driving down yields, okay, until it hits an equilibrium. So I apologize. I missed it. It's this boat right here. It's right through here. Look at this. Okay. Huge move. Now we've given it all back plus. Okay. So should we be kind of in an equilibrium? Yeah. If we go back to, let's take a look at this chart. If we just go back to where we were pre-pandemic over here, before the Federal Reserve got involved, where were we? Right here. Okay. So could this be a bottom? Could be. Okay, that's the realm for my the reason why I'm saying 6%, because the markets always overshoot either too high or too low. So where should we be? 5.5-ish. Okay, that's where we should be. We'll probably hit 6, maybe 6.25 because of the over exuberance, and then it'll kind of flush back through. So what happened was they bought all these mortgage-backed securities. So let's say they bought the bond, they bought and bought and bought and bought and bought and bought and bought. Now they have all these bonds. Now they're saying, well, we need to sell them. So now they're going to throw more supply into the market. So now you have more supply, less demand. Well, what happens in that case? You get this. The prices go down, 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 like we're seeing here, okay, driving up yields. Well, again, we're way below where we even did it over here. But again, we overdid it. Between the government, the Fed, and us, we overdid it. Okay, and we're paying for it right now. So that's why I'm saying where rates should be is where I expect it to be, why we should start to settle. But I'm trying to get some guests on here to give their feedback in the economy, in retail sales and automotive sales and a bunch of other things. So that's what I'm trying to get more and more people out there, so you guys can't say, well, Dan, you're biased on housing. Well, yeah, but I'm trying to give you the factual data that I have. So that is it there. But you guys had fantastic questions. Did I answer your question? Yeah. So yes, this could get worse. And here's what happens in a normal market. The Federal Reserve could be sitting on these things, and as people pay off their mortgages or refinance, those bonds get basically called. So they're getting cashed in. All right. Well, nobody's refinancing right now. So there's no rollover on these bonds, meaning there's nobody paying off their mortgages right now. You have in my case, I got a 2.625 30-year fixed. The rate today is 5.625. Why would I refinance? Okay. The only way my lien or my mortgage would come out of my bond, my mortgage-backed security batch, is if I sell my house. And if I sell my house at this level, where am I going to go? I'm at the peak. I'm at my third house, and my next house will be smaller. But if you're in a condo right now and you have 2-3 kids and you want to get a dog, you can't have it in the condo. You might have to sell it and buy. Is that a bad thing? No. But again, what I'll explain is I don't pump FOMO. If your thought is you're going to be in the house for a year or two and then flip it and sell it, don't do it. Please don't do it. That's my feedback. If you're going to be there 3, 4, 5 years or more, then that's when you compare rent versus buying. And you can do that analysis. We would love to help you do that analysis, but it's you guys that have to think it through. Can you afford it? That's what you got to work on. Okay, let's see this one. Last one, I think. What will be rates at the end of June? Honestly, the Federal Reserve has their meeting. They have meetings I think it's 6 weeks. They have their next meeting in June. I don't know where they're going to raise the federal funds rate 50 basis points because it's already expected, like highly expected. Unless really inflation numbers come in hotter than I even expect, which I don't know how they can be, other than fuel prices are going out the roof, and then that's going to cause the food and everything else. But if if we see higher prices at the pump and everywhere else, everybody's just going to basically shut down personally. Because of the charts that you guys saw earlier. If you guys were here when I went over these charts, the concerning information for me is right here. We have wages for, where is it? I think it's labor. Initial collaborative claims, employment, person unemployment rate. Where's the average hourly earnings? 0.3. Earnings are down. And we have hours worked, steady. There was right in here. Where was it? The income. Our incomes are down. They're not keeping pace with a lot of this. But the other piece of the equation is consumer credit. You look right through here. The previous reading we had, there was 37, I think it's $1 billion in credit, consumer credit. Within a month, we went from 37 to 52. Okay. So what again is happening? Well, we had people that had the most disposable income ever in their history back in 21. They were spending like drunken sailors. Okay. Well, now we continue, and I'll say we continue to spend. But what's happening? We're adding to our credit cards in massive amounts. So at some point, there's got to be, we just got to slow down as consumers as well. So that's not what everybody wants to hear, but I'm just telling you as it is. I mean, I'm showing you the numbers. There's consumer credit right there. Okay. The next one is, let's see, historically long-term interest rates at 4.5 to 5% have kept inflation hovering around 2%. You are correct, to 3%. If there is no life-threatening issues anytime soon, then rates should be near zero. I don't get you on that one. Antonio, thanks for the love you, man. Love you too. I don't see rates going back to zero. The reason why they were zero is basically because of the world shut down and the Federal Reserve came in and said, we're not charging anything. Here's something that'll really take you off. Did you guys know the Federal Reserve is the one that charges banks for overdraft fees because all the money clears through the Federal Reserve? During the pandemic, the Federal Reserve wasn't charging banks that late fee. And I think it was like Chase or Wells, somebody made like hundreds and hundreds of millions of dollars on late fees. And they got a lot of scrutiny, but mainstream media shoved that right under the rug. So the banks weren't getting charged for that late fee, but they were still passing that late fee charge over to us. Pretty shitty. So that's that. So that is it for today, guys. I was on here for 45 minutes. I was wanting to leave before now. So if you guys got anything else, let me know. I'd love to answer any questions you have. If you're a consumer out there, please reach out to us. We'd love to give you a quote for a mortgage. If you're looking to get pre-approved, that's what we do. If you're building a house and you haven't locked in, you should have. Reach out to us. Don't continue to work with the lender you have if they're not willing to lock you in at least up to 6 months, without any additional cost there. And a last word here, if you're building a house, please, I would highly suggest have an attorney look over your forms, your contract with your builder, because there's a lot of people just getting hosed right now in those contracts. But that's it. So let's see the next one. Hey, thanks, man. I love this stuff. I hope it comes out when I'm talking about it. I'm not trying to be arrogant. I'm not trying to, some people say, man, you just sound angry on here. I'm happy. This is just the way that I talk. So if we can be of any help, just let us know. You can reach us. You can reach me right down below. I'll give you the phone number to reach us as well. Here's our website. That's not it. Let me find this and then I'll let you guys go. So if you're still on here, there's a lot of people on here right now. Please do me one favor, and I'll just ask one favor. Click the thumbs up button. That helps the algorithms on YouTube help me get more noticed. And I would love the exposure there. So that's it for today. Thanks, guys. I want to wish you guys a great weekend. In Chicago, like I said, it's going to be a fantastic 60 and rainy. Glad the pool's open because I can watch it from my living room. But other than that, thank you so much. God bless, guys. I will see you bright and early Monday morning with the rate update. Take care. Thanks for making this whole thing a success on my end, and I hope we're living up to your expectations and more. Take care.